Welcome back to the Watch More podcast. I'm your host, Quinton Harris, joined with my co-host, Daniel Halverson, back for part 2 of the February lending update. And, if you just listened to the last episode, you saw where we touched on grants, we touched on second mortgage, home equity lines, how to get the best rate for your mortgage. And as I alluded to, we're back for the question we probably get, I'm not even going to say 10 times a day because that would be an understatement, but pretty much all day long is, what do you think rates are going to do? Where are rates going to be? And, as I've talked about, if you have a forecast, just throw it out the window because 23 showed us we were all wrong. But there are some signs that are kind of, maybe showing some signs of what things are going to do. And we're going to talk about that here briefly. We'll probably debate a little bit on where we think it's going to be. But, inflation talks and people listen, man. And we get a little head fakes in the bond market and the stock market, and the list goes on. And we're going to kind of recap all that and give you a little bit of what we think things to come. Now, reminder, next week, the new inflationary reading for PCE comes out, and this whole thing could change by the time this episode's published. But we'll go ahead and do with what we have to talk about today. So, Daniel, take it away for us here. What do we got?
It's like it never left.
Yeah.
Yeah. By the time you listen to this, something probably will have happened. But, I'll preface it by saying December rates came way down, right? They were pushing 8%. November, December, they came back down comfortably into the 6s. Riding high. Rate lock demand was up like something like 30% in January. So a lot of
with
people
a 6 handle, by the way.
A lot of people took advantage of that.
Yep.
February, as we record, it's the 21st. First few weeks of February, unfortunately, haven't been very kind to interest rates, and you kind of had a double whammy with respect to why that is.
Right.
But we'll start with CPI, Consumer Price Index. So January we got, mid-February we got January's Consumer Price Index CPI reading. And year over year inflation fell on the headline from 3.4 to 3.1, but the core rate stayed the same at 3.9%. Mm-hmm. You might be listening to that saying, okay, well, that doesn't sound too bad, right?
Big deal.
Problem is that the markets were anticipating inflation to be much lower.
Now, when you say markets, which markets are you referring to?
We are talking about basically the forecast of what the stock markets, the bond markets are expecting.
Yeah, everything these forecasters think are going to happen.
So they've got their own forecast. There's a few different ones out there. They're all generally pretty close, but across the board, they thought it was going to be lower inflation than what we got, right?
Right.
And unfortunately, the markets trade on headline numbers, right? So they see something, they immediately make a reaction, despite kind of what the underlying tone is and what the actual information detailed in the reports are. But, really I think what you had was a very overwhelmingly negative reaction for mortgage rates, really primarily just because the markets were really, really, really hoping for that March rate cut.
Sure.
And does that mean we're headed back to 8%? No, probably not. But basically the way I put it is like this. So the reason the mortgage rates went higher, pretty simple. We walked into the year and the Fed said, we're going to cut rates 3 times in 2024. Mm-hmm. The market's priced in 7 rate cuts. So we started the year saying, okay, we'll take your 3 and we'll raise you 2.5x, right?
Right.
And then the Fed's passed on cutting rates in January, which was expected. They weren't expected to cut them. They also, in their January meeting, said that a cut in March was probably not going to happen. And as of February 1st, despite all of that, the markets were still looking for 6.5 rate cuts. So not much change, right? And if they're passing in January and March, then the chance to cut 7 times in the remainder of the year is not great.
Yeah.
So still expecting 6.5 rate cuts. After this January CPI inflation that came out in the middle of February, that number has been revised to 4 rate cuts. Mm-hmm. We're still above 3, right?
Right. So
you've got it. Really what you have is a correction to an overcorrection of market optimism that happened.
Yeah.
And the best analogy that I could think of kind of when you're putting some humor in this would be, if I call Quinton and I say, hey, man, are you free at 2 o'clock this afternoon for an appointment? And he says, sure. And then I said, okay, I'll see you at 10 a.m. Yeah. So the markets completely jumped the gun. And, unfortunately, as things kind of unfolded here from a data perspective, we kind of had to backtrack and say, okay, well, maybe we're a little ambitious with 7. We're still anticipating 4 rate cuts, which is more than the Feds have said they're going to do via their dot plot, which is a survey of what all the voting members think about when they're going to cut rates, right? The people that have the power to do it. So a little bit of a correction to probably what was too much optimism in the first place, right?
Sure. I look at the markets and it's like, the Fed says, 3 rate cuts. Markets go, I don't believe you. 6.5. Here's the thing. Like, that to me screams the markets need good news. They want good news. They are starving for good news. So to your point, the markets, I'm talking about the equity market, is building in the anticipation of better news coming. And so it's such a fragile component that it just takes something like the CPI coming in a little bit higher. It didn't even come in like sky. It came in a tad bit, like the lowest of the highest you could have come in. It's what it came in at. Markets like have the worst day that they've had all year, right? And here's why. To Daniel's point, they're building in fictitious optimism that shouldn't be there. And so this little cat and mouse game started probably back in 1998 when the Fed chairman quit using what I would consider to be, very cryptic talk to explain the Federal Reserve's policy and what they were going to do. And it went from smoke signals to cryptic talk to a little bit more layman's terms. And then all of a sudden you have all these people on Wall Street that think they are Fed whisperers and that they can interpret what they're saying because it's in layman's terms, and they're going to price it into the market. We're going to price in all the decisions, and we're going to get a run-up. And that run-up is going to give us positivity until the Fed does what they did in January and kind of like break that positivity. And then Powell takes the podium. He does the whole Jerome Powell show, takes the wind out of everyone's sails. And then you get these little good cop, bad cop moments where other Fed chairmen come in and they're like, well, I think we're being a little, like Gobsley. I think we're being a little too restrictive. Oh, there's a good cop coming in because why did he do that? Well, because the markets were falling apart. Yep. And they're going, hey, listen, there's no reason to fall apart. We've already told you what we were doing. But that's how fragile this optimism is. And it's not humorous, but that's where we are right now. You got everyone trying to outpace the Fed or be that they're looking for that fresh wind of good news to really accelerate the markets. And that's because these markets are propped up on some false pretenses. That's all that is.
Well, you got to keep in mind too that the people that are moving the markets, the big investors,
sure,
if they're right and they're early, their clients benefit. The more money they make their clients, the more money they make. So there's a benefit to them of saying, okay, well, I'm going to try to predict what the market's going to do, and then I'm going to try to ride that wave up before it happens, right?
Right. And how great is it if you're the person that predicted it? Right.
Right.
I mean, you're now that person, and you're now the quote unquote Fed whisperer expert. People are going to flock to you for that, right? And so that's something that whether you just were guessing or throwing darts or whatever, you're that person at least for the next 6 weeks.
So there's a couple other things here with the inflation that I want to talk about.
Sure.
And one of them is when you look at the January inflation data, there's a thought that you could be looking at something called residual seasonality. What that basically means at the most basic level, and I'm not an economist. If you wanted to get somebody to explain this in more detail, probably want to get somebody smarter than me. But you essentially, inflation via the data that the Federal Reserve has with both CPI and personal consumption expenditures, inflation is higher at the beginning of the year than it is the back half of the year. And just like a lot of the reports that come out, there are seasonal adjustments to inflation data. And the reason that they want to have seasonal adjustments is they want to make the curve of inflation or jobs or whatever they're trying to measure, want to try to make the curve as flat as possible.
Sure.
Because if you look at the data for inflation, there's times of year where certain components, inflation is probably higher than others. Put these seasonal adjustments in to kind of smooth that out so that the numbers don't look like it's bouncing all over the place. But residual seasonality basically just means, hey, the January CPI data, the takeaway there rather is it could just be that we've got some of the residual seasonality there. And as we move throughout the year, inflation will be lower because that's historically more times than not what happens. Mm-hmm. So may not necessarily be something that is tremendously of concern. But the other component that works in our favor, which next week we get the personal consumption expenditures reading, and that for the last little over a year and a half now, that data has been better, meaning lower inflation than CPI data. A lot of that is because shelter as a percentage of the total weighted index is a lower percentage. Right. So there's less of a weighting on shelter than there are other components. But once again, the Feds, when they're looking at 2% inflation and they're looking for validation that inflation is indeed going the right direction, they're looking at PCE. So next week, good PCE, could course correct a little bit, although I would still argue that the markets move more on CPI than PCE, despite what the Fed say.
Mm-hmm. Yeah, and something interesting here. So I think it was, what was the term you're using? Residual seasonality. So if I had to take my take at that, here's what I think that means. So seasonality on this CPI that just came in. And again, guys, the Federal Reserve doesn't look at the CPI. They tell us they don't. They look at the PCE, but the markets look at the CPI, which is confusing in itself. But and there's a reason why, and there's also a reason why it doesn't make sense. But here's some seasonality. What do people do during the month of December and late November? What do they do?
Spend money.
Yeah, but do they stay home or they travel?
They travel.
They travel, right?
More.
So they travel. They go to visit family. They don't always stay with family. Sometimes they stay in a hotel. Sometimes they rent an Airbnb. Sometimes they say, you know what, screw family. I'm going to go do my own vacation and get away from family. But these things happen, right? That is measured in the form of lodging away from home. And that shelter cost, that is lodging away from home. That was the Grim Reaper that messed up the shelter cost, which messed up and boosted the CPI. You mean to tell me no one saw that coming? No one thought people were going to travel? Well, I think what they're saying is we did, but we didn't think they would travel that much. And there was a lot of traveling that took place. And that boosted shelter, which accounts for 44% of the CPI. 44%. And if that number's off, that swings pretty much half of the CPI the wrong direction. And that's what happened here. Now, to Daniel's point, that only makes up 32% of the PCE. So we already know that it's going to come in a little higher than anticipated. It only makes up 32%. So the idea is that it's not going to swing it as much on that side. I'm of the school that the PCE is going to come in at what it's supposed to come in at. It might even come in lower. That's my school of thought here. The other thing is the Federal Reserve has said the following things because, I'm making the bold prediction. I think they actually go backwards. I think they actually pull a quarter back. I'm one of like maybe 8 people that believe that. But here's why I believe that. And I could be wrong. The odds are I will be wrong. But if you do what the Federal Reserve says, and Powell himself has said, we look at PCE in 3 different forms. The core, and then we look at a 3-month reading, and then we amortize that or extrapolate that over 12 months. And then we look at the 6 months, and we extrapolate that over 12 months. Well, here's the thing. We know they have a target rate of 2. If you do the 3 months, that's like 1.8 already. That's 1.8. That's below 2. If you do the 6 months, it's like 2.2. Well, that's got a 2 handle. Hell, the core itself has a 2 handle on it. They've achieved what they're trying to achieve. So now the question becomes, are we too restrictive? Are we doing, because guys, you got to understand, if they continue at this rate, they actually can do more harm than good if they continue to hold the line here. It actually starts to create a bigger problem than what their deflation starts to become the problem, and that actually could happen. And so there's a school of thought there. I actually think they pull back, maybe even an eighth. You don't have to be a quarter. They could pull back a little here, and it could be it could be enough headwind to give that boost that we were just describing the markets need to clamor onto, to be like, we got it, here we go. So I would be surprised if, to your point, it's 3. Maybe this is the start, pause, and another one, and that's how that works. But I do think that's coming, and the reason being is I think the CPI, to your point, is a head fake, because that is that to me, they're not going to look at that. I just don't, especially with a good PCE coming in. Just my thoughts.
Well, the flip side of the coin here is they're also very closely monitoring the labor market, and
no, not the darn labor
market. We'll touch on it briefly. So,
no, go for it.
So the ADP report, which is private payrolls, right? They are the largest payroll provider in the country, so I would argue they have the best data.
Sure.
Basically, the job report for January came in with 107,000 job creations, well below 150,000. So it's about 2/3 of what was expected.
So you mean to tell me the private market, where we don't count government jobs, it came in less than expected?
Correct.
Okay, just to make sure.
Which has been the general consensus on the ADP report for a while now.
Correct.
On the Bureau of Labor Statistics, which includes government jobs, the headline number was 353,000 jobs, almost double the 180,000 expected. We talked about this last time. I'm going to sound like we're recording the same episode again, but the reality is that the actual raw job number was negative.
Correct.
Meaning that jobs were not created.
Yeah.
But thanks to seasonal adjustments, that number was revised from a negative to a positive 353,000.
Can our marketing team literally clip that reel right there? I need that to be heard, because I'm battling all these people online. They're like, oh, but the job reports are so good and unemployment's so low. Guys, get this around your thought process. It was a negative raw number. Like, it's a shell game. And that's, I mean, if you keep, the last 8 months have been revised negatively down. If you keep giving me a positive number, but then you revise it 30 days later, dude, that's like getting an A on a paper so you can take it home and show mom and dad, I aced this exam. But then it's being revised next month to a D, but they don't know about it, right? If mom and dad are like, man, he's so good or she's so good at school, they got an A. 3 days later, got a D. It's the most ridiculous thing I've ever heard. And that's what's happening here. So I want our audience, I want the people on social media to understand that, like, I understand. And by the way, we are not attacking an administration. We're not attacking, one side versus the other. We're stating facts. This is pure fact driven. That's all this is. The report is wrong. That's all it is.
Well, I think that any logical person could say there is weakness in the labor market. That's not to say we have a weak labor market, but there's weakness in it. You look at the average hours worked, basically since this time last year, the entire labor force is working 30 minutes less per week.
Right.
You might listen to that and say, okay, who cares? That's the equivalent of losing 2.4 million jobs.
That adds up.
It's a big number when you take it extrapolate it across the entire working population of the United States. So what do companies do before they lay off their workers?
They reduce the amount of hours.
Reduce their hours, right?
And if you work in a place, they haven't used the word RIF yet, reduction in workforce, it's coming. If you work at one that hasn't done it yet, you're one of the few. Most people know exactly run when they hear that. Run, not riff, run, because they do not want to be a part of that. But that's the reality of what's going on. Telling me that we have a strong labor market, telling me that the economy is good. These are things that are not adding. These numbers that they're publishing versus what the reality is, they're two different things. And we all know somebody, multiple people that have lost their jobs over the course of the last 8 months. They may not have filed unemployment yet, but they've lost their jobs.
Well, we're trading full-time jobs for part-time jobs. If you lose a full-time job, you get a part-time job, you're not unemployed.
That's exactly right.
So that's the other component here that's a little bit misleading is if
in some cases, you got multiple part-time jobs.
Correct.
We have more of that in the history than ever before.
So somebody that rushes back to the labor force to be a working member of society, they don't get unemployment. They don't show up in these jobless claims. They don't show up in some of this, but they may not be gainfully employed to the extent that they would like to be.
Well, and the tech sector is one of the largest layoffs sectors in all the job industry sectors right now. And we all know those are, we can document where those are coming with significant severance packages. So until that severance package runs out, you can't go file for unemployment or you don't get the severance.
I read that on ChatGPT. So.
But in all reality, we know that, right? We've seen the layoffs. We know that they're getting severance packages. You can't get to the unemployment line until that runs out. So then it behoves the question of, are they searching for a job or are they just riding out the severance package and saying, I'll go file unemployment? That's yet to be determined. But I wouldn't be surprised if those numbers in the unemployment line do go up. And I can't tell you when. I would hope that they don't, but I envision they might over the next 90 days.
Yeah, I think both of us hope best case scenario here is that the Feds curb inflation, they start to reduce rates before they push the economy into a recession.
That would be nice.
I.e. a soft landing. We've talked about that. Well, that's what we hope for. We want the good economy.
Right.
More people that are employed, the better place. The better place this is for everybody.
Right. Exactly.
So,
exactly. And let's be clear here. The only way this isn't a soft landing is if those unemployment numbers skyrocket.
And if they stay in restrictive territory for too long,
Correct.
the Federal Reserve.
They do these two things. If the Federal Reserve stays restrictive, meaning they don't lower the Fed funds rate, restrictive meaning tightening of the credit cycle, and these unemployment numbers start to peak, right? The jobless claims are going to be the first sign we see. They start creeping up near that 300,000 range. We could have that recession. We could have the R word coming here.
Correct. And kind of put a little bit of a bow on this, I think that my personal consensus here is that we're going to be stuck in this range that we've been sitting in for rates, somewhere between high sixes and low sevens, maybe mid sevens, depending on exactly how things go.
Yeah.
But we're going to be in that rate range until we see a rate cut. Mm-hmm. That is where it's going to be. The market's not going to have any more optimism than they have unless we start seeing rate cuts. And I don't think that the data on inflation or jobs is going to get so good, meaning higher inflation and better jobs,
right,
that we're going to see rates go considerably higher. So we're going to live in this range. The good news is, and we've included this slide in here, don't know if we've talked about it yet, maybe you have, but there is some data that shows that interest rates, mortgage rates pull back in election years, meaning they come down. That's tracked. That data is something that we'll provide here in the show notes, but that is some good news, right? The Feds say they act independently. They don't feel any political pressure, right? But you can't tell me as we move into the summer,
don't get me started,
election year, you can't tell me that the propensity to cut rates is not going to be greater than it is right now.
Yeah. You look at this chart here, and it's in our show notes. It's also on the YouTube channel notes at What's Your One More. So we go all the way back to 2000, I believe 6 on this chart, and we go all the way to current. And what we wanted to illustrate here was the sales that took place during the election cycles. And what we're going to show you here is that you'll see there is a significant dip that takes place each election year dating back to 2008, 12, 16, 20. There's a dip that happens at about that late September, October, early November. And I mean, it is not just a little dip. I mean, it's not like a ditch. It is a huge dip there. And then there's this massive rebound. It's like, okay, uncertainty. Now we've digested it. Let's go ramp up. And rates are kind of correlating with that. And to Daniel's point, leading up to that election, you see this dip in rates that happen, and the transactions continue to go up post that election. And it's not, I mean, this is literally looks like an EKG during the election, post-election. And then it's, right, it's just an upward trend before that. But, kind of going back to 2008, rates different time, different moment with home equity positions. But 2016, that was a different kind of election, right? That was a lot of turmoil, a lot of hostility. That was one of the bigger dips that we saw until 2020. We saw another one. But I'll say this, I remember working, and I remember people calling and canceling contracts in October going, I don't know what's going to happen. And I'm like, well, you're under contract. And like, yeah, but I'm just going to back out. I'll forfeit my earnest money. I want out. That's how distraught they were over the election. Do I blame the media for some of that? Yeah, a lot, right? But driving that fear home creates this uncertainty. You kind of anticipate, even during 2020, it could happen again coming into 24 here. I mean, we're just getting started with this, right? And it's something that, I would say, as I'm talking to people that are in the business, whether you're a loan officer or a real estate agent, I would prep for that. I would say, hey, listen, you're going to go all in and crush it all the way through through August, early September, but don't be surprised if some people start pulling back, and don't freak out, by the way, because that's normal.
Yeah, I think at the end of the day, we're hoping for some May, June rate cuts. We'll run that right into some election year pullback, and we'll just have an endless summer.
Let me ask you this: you mean definitely not a cruel summer, but let me ask you this:
we've had a couple of those already.
Yeah, we've had enough of that. Why do you think, as an election year, besides the trajectory and the graph and the data, why do rates pull back? And this isn't a setup question. I'm just asking. I'll give my 2 cents too. Why does the Federal Reserve tend to do reduction? Why do they tend to bring rates down during the election year?
I mean, my immediate reaction is you've got the incumbent party vying for office, and the lower the rates are, the more stimulated the economy could be. Makes the economic picture look better, right? So that's the immediate thing that comes to mind there. I don't know if you have other thoughts on it.
Well, it's a great podium platform. You don't want to go to the podium and be like, yeah, we are on some of the worst rates we've had in 20 years, and we're in a restrictive policy, and inflation is still not cooperating. You want to go to the podium and say, hey, you've seen our job reports. They're awesome. Now interest rates are great. Check. And housing's moving right along. Check. It's one of the largest sectors of the GDP. It's looking great. And, we're doing great as an economy.
Vote for me.
That's what you want to say. You don't want to get up there and someone point the finger and be like, hey, highest interest rates. But to your point, interestingly enough, who put Powell at, they're appointed, right? So who appointed Powell as the Fed chairman? You remember? Trump, right? And he was, stayed there through the Biden administration. Who's the most critical of the two candidates of Powell right now?
Probably Trump.
Oh, it's absolutely Trump. To the point, Trump said, I would fire him the minute I get back in there. Now, I don't think he can fire him, but he can definitely appoint someone else in there. Because remember, they're politically independent, right? So if I'm Jerome Powell, and I know what one person has said about me, do I really want to do anything that would give him a bigger platform?
That's fair. Yeah.
No, of course not, right? So you can kind of see how the politics may play their role into this, even though on Jerome's 60-minute episode, they're completely political independent, which I will content and say that is not the case.
In theory.
Yeah, it's in theory. But the fact that I still say Jerome Powell hasn't gone in front of Congress and said, you need to quit spending money at a deficit because you're actually undermining all the policy we're trying to do. He won't say it, even though he should. And when he's asked about the debt, it's really none of my business. And then as they press him, he goes, oh, yeah, it's a big problem. So, it's interesting. It is definitely not politically independent. But with that being said, that might be a good thing for us here going into the second, third, and potential fourth quarter. So as much as I don't like it, it may play to our audience's benefit to get lower rates, to be more affordability for home ownership as they kind of move into the third and fourth quarter of this year into next year.
Absolutely.
So, Daniel, as always, thanks for being on the show. Appreciate it. Always love the opinions and the expertise and the conversation we have when it comes to this kind of stuff. So, guys, if you like what you're hearing, please 5-star review this podcast. If it's on every platform in which you listen to, if you would go to Apple, leave us a 5-star review. Leave us some comments on our YouTube channel. We do respond to them, not all of them, but probably about 90% of them. And definitely enjoy the feedback you guys are putting on there. Till the next episode, we'll see you at What's Your One More.
I got one more shot, I'm gonna make it. One more chance, I'm gonna take it. I meant it when I said it, now it's time for me to do it. I got one life to